could have been William O'Neill, who wrote something along the lines of, most of the work that people do on equities is spent, bottoms up research of the individual companies, and yet the vast majority of the move in any individual stock price is a result of the macroeconomic forces, the liquidity and whatever that are affecting that industry specifically. It's not company specific alpha. So if everybody's spending their efforts on that small amount of move in an individual stock, and I spend all my efforts on the big picture, I don't have to be as right to, I guess, do better.
All right, Mark. Thanks for joining me today.
I'm happy to be here.
For those listening, one of the most fun I've had over the last decade is when you invite me to just come hang out with you on the trading floor. And I think we've been doing that now for like 10 years. So getting to do this today is really cool. Let's just start with really career. How did you get into macro hedge fund investing?
That's a good question. Well, I started off my career as an investment banker, and my goal, I guess, always since I was a little kid was to manage money. And I grew up in Fort Worth. Richard Rainwater, I think maybe the greatest investor of the 20th century, lived here. His son was in my class in school. My father, grew up with with Richard and was his lawyer. And so, David Bonderman moved to town later on. You had a little later on, you had like Harlan Cornvase and HBK here, and Clint Carlson. Some, even a little bit later, but some really legendary kind of money managers were here in Fort Worth that I was aware of, kind of knew, and so it was funny. We had 35 boys in my high school class, and at one point, 7 of the 35 were working at hedge funds on the investment side.
Wow!
So it's I think a lot of people in my class were sort of influenced by Rainwater and kind of wanting to get into that. And so I guess in college, my goal was to get a job on Wall Street, doing, M&A, investment banking, to try to, put myself on the track to eventually, get into money management. And I worked, I was an investment banker for about 3 years, and then transitioned over to work for a guy named Kerry Stokes, who's a Australian kind of media / mining magnate. He had bought MGM Studios with Kurt Kerkorian, and I had a particular, I was in entertainment M&A and had a particular understanding of the company, MGM. And so once he bought it, he hired me to kind of come help oversee it, get it public, et cetera. So I worked, I guess, closely with some of the C-level executives there. It didn't last that long, but a friend of mine from high school, who's a few years older than me, he and another guy in Dallas had been managing a little bit of money and wanted to start an official hedge fund, and they kind of recruited me to come over and kind of be their junior partner and sort of like CFO, COO, and kind of provide some fundamental research for them, and so that was kind of the opportunity I was looking for. And what was interesting to me, these guys were really good traders, money makers, absolute money makers, but they weren't sort of they weren't kind of your traditional, Harvard MBA kind of deep, like fundamental, build models and whatnot. They were much more kind of top down, and used a lot of technical analysis. And my passion had always been like macroeconomics and geopolitics. And so, kind of what they were doing was a lot more interesting to me, and they were making money. And so, I kind of just, I don't know, a little bit of an autodidact, I guess, just trying to figure out how things went and just kind of constantly reading tons of books and kind of paying attention to the world and seeing how it fit together, and started, kind of developed my own strategy, I guess, that way. And after a few years of working with them, I sold my stake in that fund back to my partners and started Corriente, which was in July of 2001, and kind of been at it since with a brief hiatus.
You remember how old you were when you first thought, I'm going to manage money? Was this like as like a 10-year-old or a
Yeah, probably, or younger. I mean, I never thought really had any other career goals other than running money that I can recall.
Rainwater is obviously Fort Worth's probably most iconic investor. You said your dad was his attorney, so there's only one son of the attorney of Rainwater. Like, what do you think you got to observe from that position to see what an icon looked like in the investing world at that early? I'm sure your dad, just being around that, brought stories home or just vibes home that obviously made you want to manage money.
Well, yeah, I mean, I'm sure Rainwater had plenty of lawyers. But yeah, there was one like crazy story. I guess reason I can't tell this, but and if I get the details off, I apologize, but it was when the Bass family ended up buying a big stake of Disney. And the way they had done it, they bought a company called Arvida Land, which is a big land company, owned a lot of land in Florida. And then, and I think there was a green mailer who essentially had been buying a bunch of Disney shares and was threatening to take it over unless they bought him out at a premium. And so Rainwater, I guess, conceived of this plan to sweep in as like a white squire. And so there's a white knight which would come in and buy the company. A white squire would come in and buy enough of the company to make it too expensive for the green mailer. And essentially, my dad worked on writing up whatever legal documents it was, and that night at about 3 or 4 in the morning, Richard Rainwater comes over to our house, picks up the documents, and gets on a plane, flies to New York, and like at 8 or 8:30 in the morning, goes into the board meeting at Disney to essentially make his proposal on how to save the company, and the rest is history. I mean, they ended up buying a huge portion of Disney. It was a wild success over many years.
I've heard like bits and pieces of that story. Wasn't it something along the lines of Disney was also treating the land on their books at like $10 an acre or something, and it was worth thousands of dollars per acre? So just that alone, there was this huge value accretion.
That could be it. I'm not sure how it worked exactly. Actually, I haven't heard the details on it. It was just this sort of story. It was really kind of awesome, working, middle of the night, draft these docs, like bursting into the board meeting. It's like an 80s, like, Wall Street drama almost.
What's a green mailer?
Well, a green mailer is just somebody that would come in and buy a large stake in a company and then threaten to try to do a hostile takeover of the company.
Got it.
And unless the company buys back the shares at a premium.
Got it.
And so I don't know if that's a common thing these days. I haven't heard about that in a long time.
Well, that's probably a good lead into Corriente and macros. Like, there's always something going on in macro, even in the middle of the night. Macro stories don't stop when we go to bed.
It's true.
Okay, so you start 2001. Maybe before we get into like how Corriente evolved, how do you think about research? Like, there's tons going on in the world, or maybe you would say there's actually not a lot going on in the world. There's always just a few things going on, but you got to know what they are. So how do you, when I ask you what macro is, how do you think about it?
Well, that's a good question. I tried to think of, what are the really, driving, main driving forces, of the world, of, geopolitics, of macro, whether it's, I mean, if some of the big things, like the biggest probably right now is this, this rivalry that's, I would call it at minimum a Cold War with China and the Chinese axis and, Russia, North Korea, Iran, et cetera. And, not that, it affects the way governments act, the way trade happens. I mean, there's a million different things that something like that would, impact. Or, Mark Andreessen, a decade or so ago wrote, maybe 12 years ago, wrote an essay called "Software is Eating the World," and this whole concept of how software is transforming like lots of other different types of companies, and so these are the sort of tailwinds. These are going to stay. These are constants, in the economy that are not going to stop. And so, what are those big forces that continue to kind of drive social behavior? And then so that's kind of like at a very big picture. And then where are the inefficiencies in the market? A lot of times those inefficiencies are caused by bad policy, and it's a function of this is not going to last forever, but when's it going to unwind, and how do I figure out that? So like a lot of, for me, it's been just finding specific themes where I see big inefficiencies maybe that have been there for a long time, and then trying to figure out when they're going to kind of become efficient again, and how to time that. So more.
Are you looking for things in a macro view that nobody's seeing, or are you okay just diving into what's already known but finding your spot kind of in that theme?
Yeah, I mean, I guess it's it doesn't have to be something that nobody's seen, although it feels a lot better to not be with the crowd, like to feel like you're really onto something that not many people are talking about or really thinking about. I mean, I always thought that, like, I'm relatively smart, but I'm not like the smartest guy. And, I'm a hard worker, but I'm not the hardest worker. So how can I, be the best and at what I do? And I think that the answer is that, you just got to be different. You have to take a different approach. I always thought that, I think it was like Ned Davis or somebody who wrote something along the lines of, it could have been William O'Neill, who wrote something along the lines of, most of the work that people do on equities is spent, bottoms up research of the individual companies. And yet the vast majority of the move in any individual stock price is a result of, the macroeconomic, forces, the liquidity and whatever that are, affecting that industry specifically. It's not company specific alpha. So if everybody's spending their efforts on that small amount of move in an individual stock, and I spend all my efforts on the big picture, I don't have to be as right to, I guess.
Is it lonely?
Do better. I don't find it lonely.
Or maybe is it lonely to be so convicted on something that the world's not seeing yet? Or do you like that feeling of kind of being in isolation? We're going to talk about '08 in a bit, but I would imagine there was a time where the housing prices are going crazy and you're like, I mean, if anybody's seen The Big Short or read any of these books, like it was clear as day to you that it was going to crash. But there was probably a year or two where everybody was just laughing at you, like, look at Mark over there betting against the housing. When
we were fairly lucky in that specific instance because sort of right after we got the bet on, it started working. It didn't really go against us for very long. It's something we watched for a long time. But it had, I've suffered big drawdowns, big losses that, weren't ever recouped because, either timing was wrong or the thesis was wrong. That's really, tough. It's something, I don't know if lonely. I mean, I've always had, good support and professional support, people with whom I've collaborated. And so I guess, if misery loves company, there's always a little bit of company, with me when things weren't right. But I mean, you want people to agree with you, later.
Yeah.
And so that's part of the deal.
Okay, well, let's go back a second. So tell me, like, how the research began or the theme began against housing. You kind of started betting, I think, or investing in '06 in
that's right,
a collapse, but that thesis probably started in what, '04, '05?
Well, I mean, even before then, although I wasn't betting against housing, I had been thinking about it since at least January of '03, maybe, or so. I can't remember. You can go back and look. There's an article in the Wall Street Journal by a guy named Patrick Barta, who was a good friend of mine in college. And, I think it was in January of '03, but we were having, drinks in New York, and I was explaining this housing thesis like in '03 to him, and he ended up writing a story about it. Didn't mention my name, but it was obviously pretty early on. I was wrong, at the time, but I was very long a lot of commodities in the mid aughts, and I knew that a lot of that demand was coming from the booming housing market, and so I realized that that was a big risk to my thesis, and so I guess always out like looking for signs that that was going to be turning, and I was certainly expecting to find signs that something was going to happen at some point, and that was my friend Kyle Bass, we talked all the time back then, and so we were kind of both doing really well on this commodities trade, and both very kind of nervous, and people knew that, and so we were able to I guess see enough. I mean, the signs were there. It was really
What were the signs to you?
God, I can't remember all the signs. I mean, you were starting to see, though, credit spreads starting to move wider on some of the, riskiest types of names, but I think delinquencies and, I mean, a lot of just the credit data was deteriorating even before you were seeing really the credit markets reflected, and sentiment was very extreme. And I always look to, I always say that, like, everybody wants to be a contrarian, and a lot of times, you'll be in a room and you ask a group full of, bears why they're bearish, and they'll say because everybody else is bullish. And then bulls at the same time will say they're bullish because everybody else is bearish. But really, maybe there's not, a clear read from sentiment, at being at an extreme. But it's kind of like the Supreme Court's definition of pornography. It's like, it when you see it. And, this was a time when everybody in the mortgage market and the whole loan departments at different banks would swear up and down that that on a nationwide basis, on average, housing prices can't drop. Like, literally, their models, they didn't even go negative. It's like, if one pocket of the housing market is weak out in California, well, it'll be strong in Texas or whatever, but never across the board. And so these securitizations, they'd include loans from all over the country, and so they get that geographic diversity, and there's just this view that it was absolutely pervasive that the worst case scenario was slow growth. And so it seemed that we had that kind of perfect sentiment set up, right at the time that all the data was deteriorating. And I guess people were just flying a little bit blind.
But you were like in the 0.001% of people that still saw you make it. I mean, from your advantage, it's easy. So what gave you the, like, all right, we're going to raise money around this idea and we're convicted and we're going? Was there another inflection point, or it was just a series of all these kind of seeings of data?
Well, I mean, to me, it was seeing the optionality, in credit default swaps, getting into the instrument and seeing that, the payoff, if you were right. And it just seemed the risk reward was completely out of whack. I mean, you could buy, insurance policies essentially on bonds where what your worst case scenario it is. It's just spending premium, but your upside is epic. And the way that the kind of bond waterfalls flow, like, you would have the lowest grade bonds get completely wiped out before the next grade would even get impaired at all. So it wouldn't take much carnage to have like full defaults on some of the lower rated tranches of these, subprime RMBS. So I think it was more the instrument was so compelling that we found to give us an incredible kind of risk reward setup that really was the key.
So when you're going around and your pitch is like kind of like the world's about to fall apart, or the housing market, maybe you didn't know the gravity of what '08 would turn into, but you at least knew housing was gonna, and you're sitting in front of investors that are probably, they enjoy like an up and to the right thing.
Mm-hmm.
Were most people investing with you as a hedge against their optimism, or was everybody like, oh, we see it too, or we like Mark? Like, I just have to imagine to have the guts to put money into that investment where the world was in '06. You're taking if you're not already as deep into it as you're feeling like, okay, I guess this is a hedge on my optimism.
Yeah. Um, well, I think a lot of people did see it that way. They saw, okay, well, look, I mean, the payout's so huge. If they're right about the housing market, the payout's so epic, but the consequences for the rest of my portfolio are so bad. It makes sense. I think we did have, a good number of hedgers, and then, we probably had a lot of, individual investors who, just loved the risk reward setup,
Yeah.
which was so good.
Do you think, just psychologically, do you think it was a good thing that you were right so quickly?
Mm. Well, it was I was right so quickly on that trade, and then right after it, the Europe trade, and it was really, yeah. I mean, that probably made me, tried to keep my ego in check as much as possible, and obviously, like, it's not like I just came up with these things. I mean, it was collaborative efforts and whatnot, and probably more of it was, my willingness to just like go big.
Yeah.
My kind of personality, as opposed to, being like so brilliant. I didn't really think of it. Uh, I guess it maybe it made me overconfident. Later on, obviously had the big, short on the Chinese yuan that cost me a lot of money. And, I don't think I was wrong on the thesis. Still may play out. You had, the Shanghai Accord in 2016, which was essentially, massive intervention by Western powers to avoid a Chinese, yuan devaluation. But at the same time, I had I had put this trade on like 6 years before that anyway. So it's way early at best, or you could say I was just completely wrong. But there's no question that I think, thinking back, that I would have wanted, I should have, like waited for more cards to come out of the deck, before, pressing that next bet.
What's the quote? The difference between being wrong and early is indiscernible.
I mean, that's right. I mean, it was wrong. Like, it was a total wipeout, or virtually a total wipeout, my China bet. And you still, and there actually was a devaluation. It wasn't, enough to really move the needle, but, yeah.
Besides being early on China, though, what did the whole China thing maybe teach you about the world, or teach you about how governments work? Or because eventually you were right. You were just early in making the call of what happened.
Yeah.
Now, as you sit and look at macro, like, that's obviously a new tool that you bring to the table when you're looking at a situation that things can probably take a lot longer to play out. Was there something you left that situation with that will be a tool in your tool chest going forward?
Well, it's a good question.
I've got a lot of good questions for you.
Yeah. Well, you can always learn a lot from I mean, everything has to be like a victory or a lesson. There are probably a lot of, lessons that I learned. I think, maybe some of the more important lessons didn't have to do with investing as much as, like, I had 3 little kids. I had 2 dying parents, unfortunately. And I, was sort of obsessed with these trades that, really were kind of out of my hands, whether they worked or not, for a long time. And so I think, maybe that kind of helped wake me up to, pursuing kind of quality of life, health, that sort of thing, like a little bit more, family time. I took a hiatus for a while, really to mostly focus on, family and health, after that China trade.
Let's go back a second just to Europe. So you and then we're going to get back to where we just were, but you run a great trade on the housing decline, which basically, as that trade was going on, you were already beginning the trade on Europe. Is that correct?
Yeah.
What'd you see there?
Well, I saw that, there were a lot of, credit bubbles in the world, that it wasn't just US housing. And, I'd always, interestingly, since college, I had thought about the European divergence trade in a sense. I was at a finance class, and it was happening during when the Maastricht Treaty was signed, and it was a small class with like 4 or 5 students in the class, and one of the students in our class was from Germany, and we spent a lot of time talking about it, and this idea of multiple fiscal policies and a single monetary policy, convert um, seemed like it can't last forever. If because you have these different countries that have different economic fundamentals, but yet the goal is sort of to drive borrowing costs to the same level. And so the convergence trade lasted for a long, long time, but I assumed that eventually, it couldn't last. So it was the kind of thing that was in the back of my mind for a long time, that this would happen. Wasn't really thinking about playing it or anything. But then I read a book, a short little book. I can't remember the name of the book, but the author was Louis Vincent Gave, who's a close friend of mine, really great, macro thinker. And he had moved. Actually, he and his family moved to Hong Kong from France, and thought Asia was the future. And in his book discussed some of the risks and problems in the European sovereign bond market. So I read the book and started doing a deep dive. And the more I read and figured out how the sausage was made over there, the more I was convinced that it had to blow up. And so I started to prepare for that fund. I recruited Louis to join me on managing that fund, and then it was kind of slow moving. I don't know if I'm answering your question exactly, but it's kind of slow moving until that summer of '08. And I was just watching the credit spreads, not of the countries that are in the EMU, the Economic Monetary Union, but the countries that had hoped to get into the EMU, like the Bulgaria's, Romania's, Latvia's. And suddenly, that July, you just had spreads over German bonds like blowing out. So like I remember, like 7-year like Bulgaria over Germany went from like trading flat to trading like 15 or 20 basis points over, and nobody was paying attention. And you look at these charts after a convergence for decades, or not quite decades, but of borrowing costs, suddenly out of nowhere, right in the heels of the subprime and with all the banking crisis here, suddenly those credit spreads widening. It seemed like the dam had broken, or was about to break, and that was kind of the catalyst to really raise the money fast and put it to work.
And maybe we can pick on this. Goes back to the research question. This is just for me. I buy real estate around Texas. My research is kind of like down the street. I can drive to my research. But when you're doing research on something to the average person that's complex, it's across the world, you're dealing with like government policy. How are you doing that? Are you calling people over in Europe? You obviously read a book, which led you to other things. Like what all goes into a full research to where you come out going, okay, green light?
Yeah. I mean, we had analysts, reading, bond prospectuses. We spent a lot of time with, the trading desks of all the big firms that traded these sovereign bonds and traded, sovereign CDS. We had to dive deep into the instrument, how does the default like become official? What triggers the CDS? We spent time talking to the sovereign credit rating analysts, like at Moody's and various places. It was just, basically learning everything you can, your whole team, and getting to know the people on the trading desks that trade this stuff, and I mean, I think what was really interesting and the mind-boggling thing was that, you know, European sovereign bonds had no, this is not the process, this is like a light bulb, is that the European sovereign bonds have no risk weighting. And so what you can do is you could buy a European sovereign bond if it's an EMU bond, and then you could immediately take it to the ECB and borrow money against it. The 100% face value, there's zero haircut. So there's zero risk weighting. Mm-hmm. So what banks banks in Europe had been doing the same stuff that the banks in here in the United States had, lending to bad credits for a long time. And so, but what they were able to do, and the banks in Europe were much larger balance sheets than the banks in the United States. But what they could do is they could create tier one capital. In other words, the equivalent of equity, by selling CDS, because you're selling CDS, you're selling an insurance product, right? And so, and when you sell it, you get a stream of payments, right? And so they could take the stream of payments and present value the stream of payments. And since there was zero risk to the bonds as determined by the ECB, you could actually create a net positive value that counted essentially as equity, tier one capital on your balance sheet. And so that's what these, banks, particularly like in land banks in Germany, were doing, but a lot of them were. So, kind of what happened is when, the banks, maybe the ECB looks at it that way, but as the banks started to wonder about their counterparties, when credit spreads started to blow out, they started to ask for more collateral, which they didn't have.
Okay. Sidebar.
Yeah.
So you talked about being at the top of your game, and then a few years after, you will call it maybe not rock bottom, but you hit a low.
Yeah.
I want to talk about what you did. You hired and one thing you always say is, I've noticed, I wrote this down, every author that you read that you like becomes like one of your friends. But you essentially read a book. I have it in here by Josh Whiteskin,
yeah,
who introduced you to Tim Ferriss. And when we were talking a couple weeks ago at lunch, you were like, I invited these guys into my life to help me rebuild kind of my process and the way I approach life.
Mm-hmm.
Can we talk about what that all looked like and how your life changed?
Yeah. So, I just knew that I had to I was very spread out. I had a lot of employees and I had, a lot of chaos, and I really didn't feel like I was on top of it. And so, I read the book, The Art of Learning by Josh Whiteskin, and I was blown away by it. And, Josh was, he was the subject of the movie Searching for Bobby Fischer. So he was
really?
Yeah, he is this phenom chess player, I think 7-time Scholastic champion in the U.S. And he had, then this movie came out and it was a big hit, and it was a book. It was written by his father, and it kind of caused him to lose the love of chess. And so he got into, martial arts, long story, and ended up, becoming a world champion, and wrote a book about his, learning process. And I realized, that I needed that. And so, and so they made a lot of recommendations. They looked at, my life, how I broke my day down, and how my team broke their day down, and, and divided it into, exercise, work, family, whatever it was. And then made a bunch of recommendations about how I can improve, a lot of those processes, diet, exercise, how to get the, most, quality out of, research time and whatnot. And so,
what's the biggest needle mover that, if you had to say that, there's probably a lot, but what was the one big thing that changed it all? Is it exercise?
Yeah, jiu-jitsu was the big thing. I just became completely obsessed, as you know.
Why do you think that is? Why do you think so many guys on Wall Street get into jiu-jitsu?
Well, it's really uncomfortable. Or it can be when you're getting choked or you're twisted around, you can't move, you can't breathe, or you can't breathe well. And it's really easy to panic, but you really have to, get your mind to a place where you're not. And I mean, you immediately shut out everything, and you just become the ego, all of it, and you just become like in that moment. And it's super complicated, complex. It looks like fairly basic maybe if you're watching it, but like the more you get into it, the more there is to it. It just keeps getting deeper and deeper. And so it's like puzzling. It's a challenge. I mean, people call it like 3D chess or whatnot. And then, I mean, I'm not a chess player, but that makes intuitive, sense to me. It's exhausting, and you get in phenomenal shape, and it unlocks athleticism that I guess that I didn't know that I had. And and I loved the people that do it, I guess.
How long did it take you to become a black belt?
It took me 8 years to become black belt, which is fast. But I did spend 4.5 years doing twice a day for total 3 or 4 hours a day, 5 days a week. So it was like really, and I'd been a wrestler before in high school and done some other martial arts, did judo as a kid. So
I will have memories of you forever. Faster. Every time I'd come visit, you'd be walking out of the dojo like sweaty, like clearly had been doing, and then we'd walk like right onto the trading floor and you'd start checking what's going on there. And then we'll talk about your one wheel, but I thought it's one of the most unique like setups I've seen. You can literally train next door and then walk straight into work.
That's right.
And I'm assuming that's had a huge positive impact on how you work.
Absolutely. The jiu-jitsu slack lines, I don't know if you ever do a slack line, like a little tightrope type thing. I mean, they're awesome for, balance, but also just something to like take your mind off of everything that's going on. So I have slack lines, at the office and mats and gym, and sometimes just go clear to the head with some of that.
What can a black belt do? Like, how do you know you've become a black belt?
Well, aside from getting, the
well, you get it, but like, do you have to, there's a certain checklist you have to be able to do X, Y, and Z, or like, how do you prove that? Like, obviously you have to get every belt before that, but what defines a black belt?
Yeah. I mean, there may be, I actually don't know the specific, like if there's certain, specific, there's different, like people may have different definitions. There's the, but you pretty much have to be, proficient. And I don't know what I specifically like did or skills I had. There wasn't like a test that I went through. However, to some extent there is, in that, my teachers like, basically made sure that I kind of was there. Yeah. Yeah. And multiple, agreed that it was time.
All right. I want to now go back maybe to China, but not necessarily to talk about the trade. It's now like 2024. You kind of said we've been a Cold War, and really a lot of our discussions over the years when we're talking just about the world has China involved in it.
Yep.
You probably think about China a lot.
I do.
How do you think about them today in 2024?
That's a long answer. I think that...
And we have time. You don't have to give me the hour-long answer. We'll do it at lunch, but give me as much as you want to give me.
Well, conflict is heating up, and it has been for a long time. And China's been building up its military capabilities for a very long time. And it's allied with a lot of countries who are increasingly, at war, or whether it's Venezuela, threatening to, take parts of Guyana, or, Hamas, attacking Israel, proxy of Iran in a sense, or it's, all these different conflicts, I think, are serving China's interests in that the United States is getting spread out. And at the same time, the United States hasn't, invested in, maintaining a lot of its strengths, military strengths, and certainly our allies are even, more guilty of not investing in their strengths. So I don't know if it means that we go to hot war, or if the U.S. ever gets to that, or um, uh, it just makes the U.S. in a weaker, negotiating position.
Go ahead.
But I think that one of the things that's happened that's kind of scary is China's model has been to suck in capital from the West and then use that to build out its own industries to compete with the West, and then also use that to invest in other countries to gain allies and to make those other countries sort of dependent on China. And the capital flows into China have stopped in many ways. There's still capital goes in, but it's still more and more through the trade account, running bigger and bigger trade surpluses. And so, that is a little scary because one, like maybe the game's up a little bit in terms of people starting to recognize that, it's kind of a roach motel. If you send your investments in, the money doesn't come out. And so China needing to, I guess, make up for it with the lack of dollars with, mercantilist, trade policies. And so, of course, that is not politically, palatable to, countries in Europe or the United States who, big car manufacturers, and suddenly, that's reversing and they're importing a lot of cars from China. Tensions are rising. They're going to continue to rise. I don't know, how it comes to a head or if we reach a state of, detente. I think that it's, I think, I'm a believer in this, kind of fourth turning type idea where, I think we're in that fourth turning where a lot of, institutions of the prior, several generations are destroyed and new ones are created. And it's happening, a lot of things are causing that to happen. China's, one of them. So it's, I think that really part of it is you have to think about with it as an investor, not so much, it's more like how do you invest in this environment when the geopolitical risks are rising, and that's kind of maybe the best answer. Yeah.
When Xi Jinping came over to San Francisco a couple months ago and they cleared downtown and that had been riddled with homelessness and drugs, and then we were told forever, well, it just kind of that's the state. And then in 24 hours, it was cleaned up for the Communist Party to. From a trader macro perspective, how did you read that? Is that's obviously appears weakness.
Yeah.
Why did we do that?
Well, I guess that's sort of the practice. It's for foreign leaders, but it does it draws it's not a good look. I don't think if you can clean up for a foreign adversary who wants to take you down, but you can't clean up for your own citizens. I guess the main thing, the biggest, outside of like Bitcoin, for me, the biggest, macro theme that's investable is this, migration, to, Texas and to other states. And the way I think about it is sort of as a taxpayer, you are, when you pay taxes, you're making an investment where you live. You have to, but it's still, that's what you're doing. And I can go into why, but
yeah.
So, it's think about countries like, Monaco or the Caymans or Switzerland or Ireland, they're tax havens, and a lot of businesses or elite, global elite people have, moved their assets and moved themselves physically to some extent to some of these tax havens. But that really hasn't been much of an issue for, non-elites who are less mobile. You're kind of tied into where you are, generally speaking. And I think that the pandemic really changed a lot. One of the big changes is we came to realize that we didn't have to spend as much time in the office to be efficient. So a new kind of equilibrium is figured out. And I think like the pandemic suddenly created, you know, more demand for residential real estate and at the same time less demand for commercial real estate. In other words, individuals thought, oh my God, I don't have enough space at home, because of lockdowns or whatever, or the businesses realized, oh, I got too much space at the office. And so suddenly we were short residential real estate and long commercial real estate. And that unlocking also of not having to be, more people being able to work, kind of remotely sort of set off, a little bit of a tax arbitrage, where suddenly taxpayers can say, okay, if I'm not getting a good return on my tax investment where I live, then I just go somewhere else. And so, I mean, I think that there's migration like to Texas and, other states, it started with the advent of, air conditioning, because there's much better weather here, except, when it gets really hot, if you've got air conditioning, it's great. So that started it. But now this is kind of this new wave. And, I think like Governor Rick Perry was very focused, for instance, on, his job as governor. He thought, I not put words in his mouth, but I thought it was great. His view was, let's attract companies and people to come here because we have a better business environment for people to work in. But the pandemic has really like set that loose. And I thought that, Xi Jinping's visit to San Francisco was just a very, stark reminder of how poorly taxpayers are treated, in California, or specifically, in San Francisco. There's not a good return on investment. In other words, I guess like this big theme is, for me, is, the first thing I think about is, yes, that theme is correct. Like, this is a long-term thing. It's going to continue to happen. It's cheaper to live here. There are other weird little things like cities like San Francisco, port cities, it used to be really important. All the populations congregated in ports, because that was where the trade met. But then you've had advances in like communication and other things that have not required everybody to be right there where the trade happens. And so, but the downside of that is that you're limited into how you can spread out your population. You have oceans or mountains or whatever that limits. So if you want to take in more people, you have to grow up or out. And so, typically what happens is the wealthiest people can stay sort of there in the city center, and the rank and file have to move further and further away and have longer and longer commutes. And, in Texas, for instance, you don't really have that. Like Fort Worth, Dallas, you've got lots of pockets of industry and wealth spread out all over, and anybody can live pretty close to where they work, regardless of how much money they have. So, I think a lot of things are really pushing this, migration trade that will continue for a long time. I don't know if that's coherent.
You're making my heart pitter patter owning real estate in Texas.
Yeah.
What do you think, real quick, about inflation?
Well, so inflation is how, we've run up very large debts and are running very large deficits, the government is. And inflation is how, historically, those debts are paid off. So I always think of inflation as like a tax on owning a currency. So the way I think about it is that like the tax on owning a currency is inflation plus, productivity in the economy. Or, another way of saying is, if you had $1 or $100 basket of goods at the end of a month, at the end of the year, the end of the next year, it's $102, then you've had 2% inflation. But if you've had, non-farm productivity growth of 1%, then that basket theoretically should have dropped to $99. So that delta is the tax that you pay on dollars. Well, now we're in high growth and high real growth and high, inflation. Another way of thinking about it is the cost of holding a dollar is, the rate of nominal GDP. It's real GDP plus, whatever value's added. And so the tax on holding dollars has gone up a lot with inflation. Instead of it being 2.5% or something, it's much higher. And that's obviously caused people to move into other things like Bitcoin or gold or an out of kind of long duration, reserve assets. But this is how, most people probably don't realize, like in 2020, at the peak of the pandemic, U.S. government debt to GDP hit something like 137%. Do you know what it is now?
I have no idea.
It's like 120. So actually, debt to GDP has come down significantly over those last 4 years, even though we've been running big deficits the whole time. And the reason is because the GDP has gone up because of the inflation. So the actual debt burden kind of has been dropping, and that's the game. That's always been the game is to reduce the value of the obligations, the debt obligations, through inflation. And so I think, though, it does risk, getting a little bit out of control. Supply chains are stretched, and we've seen that they can be broken and they can set off inflation. It's you have like banks that are loaded up with, a lot of commercial real estate that is probably not, appropriately marked, that losses are going to have to come, and the Fed is going to have to be, aware of that as well. So, you've seen like, but the underlying economy, is strong. Like there are a lot of, productivity gains coming from things like AI and just the benefits of investment in technology for a long time. I don't know how out of control it gets. But I guess the Fed so far, everybody was expecting cuts to come in interest rates, and they haven't come. So, on the surface, it looks like the Fed is tight or playing tight monetary policy, but that's not really the case. Global liquidity has been expanding for about a year and a half. And a reason for that is the rate at which the Fed has been tapering its balance sheet. They basically not tapered it nearly as fast. So you've got this issue of maybe being a little tighter at the very front end with interest rates, but providing plenty of liquidity to the economy, in the back end through effectively, quantitative easing.
Yeah, yesterday's print, it was up.
Yeah.
I think in our office, we're not really, again, I don't know what's going to happen. I don't know what's going to happen tomorrow, but we're not really planning for any cuts this year anymore after yesterday.
Yeah.
And I think, I had Barry Sternlick on a few months ago. He probably said it in a way that made them, easy to understand, but he was like, high interest rates don't kill government jobs. They don't kill healthcare jobs. They don't kill education jobs. They usually will kill the business sector, specifically construction and construction-related activities. But when you have a $6 trillion infrastructure bill that you're also pumping into the system, all the big contractors around the country would tell you our business was 80-20 private to public jobs, and now it's just 20-80. And guess who pays the most? The government.
Mm-hmm.
So you have all these employees that in a typical higher interest rate environment would be getting laid off. They're not only not getting laid off, they're getting paid more to go work on government projects. And so his whole point was like, you can keep raising them, but it's not, you're kind of pushing on a rope. It's not having the intended consequences on inflation that we would hope for.
Yeah, it's true. Well, they're not really tightening though, as well.
Yeah.
Like through, so, we track like global liquidity. I think like the best is this cross-border capital, Michael Howell, who monitors it, which is a great like free Twitter follow.
Who is it?
Michael Howell,
Okay.
Cross Borders Capital.
Okay.
But he'll track like global liquidity, which is, it's not just, money supply, but it'll also be like bond volatility, stock volatility. Like the lower volatility, the more, the better. The lower volatility an asset is, the better collateral it is. So you can borrow more, you can leverage more against it. And so, global liquidity has been, expanding for a while. It probably will continue to expand for a while to pay for a lot of the, you know, programs. And I mean, the debt has to be monetized one way or another. So, um, yeah. So if it's not, I mean, I guess what I'm saying is they're not really like pushing on a string. They're not just, it appears that they're operating in a tighter manner than they actually are.
Okay, let's just talk about Bitcoin. You've been in it for 7, 8 years now, maybe longer.
10.
10.
Yeah.
God, those 2014 prices feel good.
Yeah.
But you said that's something you think about a lot. Maybe my first question is, do you think about Bitcoin differently today than you did in 2014? Now that you've seen 10 years of how the world's interacted with it, or is it still the same thesis?
Well, it's kind of the same thesis. I mean, I started watching Bitcoin when it was around $1. And I watched it go up for, 40,000% before I bought any. But it was fascinating to me, but just as a project or whatever.
How did you get introduced to it?
My brother-in-law, Blake Lipscomb,
Okay.
was my partner at the time as well. Somehow came upon, something written about it, and he just kind of started diving into it. And
okay.
I was fascinated by it. So it really made me actually like create a framework that I use for investing, because, it was funny. There was so much hate for Bitcoin, which made no sense. I mean, I never really got the sort of religious vibe on either side, but it seemed like everybody that loved it was like religious about it, and people that hated it were religious about it to the point that they, kind of weren't rationally thinking. I saw you had a picture of like Charlie Munger out there, but Charlie Munger like would never apply any of his actual rules of investing to analyzing it. He just called it double rat poison. And, I actually pointed out to a friend of mine that was like the worst trade ever. He's been calling it double rat poison since 100. And the friend said to me, well, he wasn't saying it was a bad investment. He was just saying it's not good. And I said, well, maybe that's the case. Although he seemed to want people to think that it was a bad investment. But, so I basically kind of came up with like what gives, like, Bitcoin doesn't return anything. It's just
it's like
Munger's
gold. Case,
right? And so I tried to sit there and say, okay, what gives any asset value, any investment? It's not like most of the time we just think it's a discounted stream of future cash flows, and that's a component of it. But I've kind of identified what I think are like the 6 things that, the 6 factors that give an asset value. And it's just changes in these 6 factors that move the price of a good. And I built this framework specifically around Bitcoin. And so, the 6 are, access, awareness, security, patina, use as collateral, and then, intrinsic value, kind of the discounted, cash flow type thing. And so, like getting through those, like, access, you could have a great asset out there, but if you can't buy it, then it's not going to go up in value. If it's not easy for people to buy, just, techies can access it with, complicated wallets or whatever, then you're not going to have broad access. But, awareness is another. Companies spend, billions of dollars on marketing campaigns to create awareness around their products. And the more aware people are, the more likely they are to own something. This applies to anything, whether it's an investment or, whatever it is. Security is a big one. And this is how I kind of came up with my thinking of what the tax is on $1. Like, dollars are super secure, but they're not completely secure. Like, they lose value. They lose value because you pay a tax for holding them. But it's worth it. Like, you pay your taxes in dollars and you buy stuff in dollars. So it's not like you don't get anything for it, but you just have to pay a tax to own it. Or like gold is another one where, from a security perspective, like there's a relatively limited amount of gold out there, but it's But if the price goes up, 10x, they'll start digging up, all of Colorado to get more of it, or they'll crash a satellite into an asteroid that's got a bunch of gold on it, move it into the, orbit here eventually. Um, so security is one. You could buy a bond from Namibia that yields a lot, but you don't know if whatever the currency there is in other words, it's the security plays a role. And then patina is one, like, you can think about how, I mean, like GameStop, for instance, or some of these different, meme type stocks, or it could be, people may like Bitcoin because it shows that you're, tech forward or libertarian thinking or whatever it is. Or they may like, euros because they believe in the project, or they may like, whatever it is. They may like Tesla stock because they want to be like Elon. So patina can drive things. It's emotion, can drive holding things because you like them. Baseball cards, have value because people like to own them. And then obviously the return, that you would get. But I mean, if you think about it, a bond gives you a certain amount of interest, but if it's priced in dollars and you're getting paid interest in dollars, then you really need to subtract the tax that you pay on dollars from the interest to see what you really get, and maybe a negative. So in that sense, maybe Bitcoin, yield more than a bond, even though it doesn't have an interest rate because it's priced in Bitcoin, not priced in dollars. And then the biggest one is used as collateral. And so, like for a long time, people like talked about Bitcoin as being similar to tulips. Like this was the constant, narrative early on, particularly, which was the most absurd argument because there was no leverage in Bitcoin. You couldn't borrow against it. You couldn't go to your bank and say, "Hey, I've got $1 million of Bitcoin in this wallet. Will you lend me money against it?" They'd laugh at you, right? There was no leveraging it up. Well, the tulip mania came because people were actually able to take tulip bulbs and use them as collateral to borrow money, which is completely absurd. Of course it's going to blow up, but it's that process of leveraging something up.
Yep.
that gives it that huge value. So like the European sovereign debt crisis, right? The reason that there was so much massive supply of all these things is because because they were so leverageable. There was a zero haircut the ECB would apply to them. So basically, it's just massive amounts of every bond is perfect collateral. So there's demand for those bonds because you can turn them in for cash immediately. Anyway, those are the kind of the six things and that give value. And as it applies to Bitcoin, I mean, I think all of those are turning more positive. Access. I mean, how many billions of dollars would it cost to launch a marketing campaign to get as much awareness for your product as Bitcoin gets, for free?
Yep.
Access, obviously, it's improved dramatically with, ETFs. Security. There's very low tax on Bitcoin, and that monetary policy continues to tighten. Not everybody's able to secure their wallets, or there are other risks to security, but all these things each one of those items kind of continues to improve.
Okay, let's finish on AI.
Mm-hmm.
Do you have any thoughts about are we in a hype bubble right now, and are we beginning the era of dramatic job loss and deflation because everything's going to be automated? And like, how is AI playing into your view of the world?
Okay, so I think it's just epic, like massive, revolutionary technology, and it's a top down. I mean, it's a bottoms up tech. So like, think about things like electricity, right? We figured out how to manipulate electricity. That it still took over a generation before we started saying, oh, wait a minute, we can electrify factories over here and make them much more productive. And then the infrastructure that was required to do all that, it takes many, many years before you start to get the productivity benefits of harnessing electricity. Or railroads, these are massive, or canals, massive upfront investments, and then you have to wait for a long time before you start to get the productivity boosts. from them. Or, the last mile of, high speed cable data, going from dial up to high speed. I mean, that took a huge amount of digging and infrastructure before you actually got that. But AI is like kind of the opposite. Those are all like top down technological transformations that, took huge amounts of capital up front, and then they over time permeated and you got the productivity benefits. But AI and like ChatGPT, I mean, you have the most productive people in the economy suddenly making themselves much more productive simply by downloading an app. And so I think that's like, you had a lot of layoffs in Silicon Valley a couple of years ago, and I think the narrative at the time was that this is things are getting bad, and so they're battening down the hatches, when actually maybe it was more a function of they were just becoming so much more efficient because they were the earlier adopters of AI. It's like, where it goes in the future, I don't know. I mean, I think that the only thing we know is that, I mean, technological change has been happening, and it's been happening at an accelerating rate for generations now, and it's likely to continue absent some sort of like great filter, hitting a great filter, like it's World War where we destroy ourselves or something like that happens. And so in many ways, I just feel like you don't really have a choice but to sort of like embrace the changes that are coming.
Yeah.
And exactly what they are, I don't know. But I think that it'll probably get harder in many ways to, compete, and gain an edge as a human. So I don't know if I'm like prepared to. I'm glad I'm my age and not super young coming out. Although right now I'm sure it's like really interesting if you are coming out.
Bill Gurley and Brad Gerstner said on their podcast, they were just talking about kind of what you said, is traditionally companies get really big and then they slow down, they get bloated, and they just kind of start to die.
Mm-hmm.
And for the first time in history, I mean, you look at like Fang or whatever it is now, they're actually gaining speed and gaining velocity at the size that they are.
Yeah.
Which is interesting.
Yeah. Yeah.
It's still been like one of the best trades, is just keep betting on like the big seven.
Yeah, it has been. And it makes sense. They're able to, utilize, these new technologies, much more quickly than the rest of the world. And, I mean, technology is growing faster and software is growing faster than the economy overall. And that'll probably continue. So
is there any theme I didn't ask you about? Cannabis.
Yeah. I mean, I think cannabis is just another one of these that's really interesting to me, that, you have, it's roughly like in the United States, it's about $100 billion market right now. And, or so maybe it's larger. And, roughly, 70% of that is illicit, and 30% is, legal, like state legal, whether it's medical or adult use in various states. And so, you have this competitive landscape where the legal players, they pay more taxes than they're more highly regulated and pay higher taxes than any other businesses in the United States. And so the cost of doing business is extremely high, and the low cost producer, marginal producer, is the, illicit market. These are literally criminal enterprises. They're not adhering to, strict labor standards or environmental standards or paying any taxes or anything else. So, so the legal companies, have a tough time competing, and it's been a tough theme because of that. But the flip side is that, there are companies that have, most have failed at this point, but there are some that have been able to survive and somewhat thrive in a world where, it's not a level playing field at all. But I think inevitably, this, the playing field will level out. And one of the things that's happened is as cannabis has become more socially accepted, it's sort of become kind of de facto legal. Like you don't have the kind of crackdowns that you used to have on, illicit players. And so that's made, the competitive environment even more difficult for legal players. But as you get, I do think enforcement's improving. The incentives for governments are very high. Like in Illinois, for instance, cannabis producers pay more taxes than, alcohol than the state gets from alcohol. And so the incentives for governments to enforce laws, are high. And then, there's the potential for federal reform, whether it's banking or rescheduling. But there's constant other reform, just, state level legalization, whatnot. So it seems like the tailwinds for the legal sector are starting to pick up. And from my perspective, it seems that, what you've got is like this market share for the legal sector that's like 30% right now. But over time, whether it's, 2 years or 10 years, that goes to 100%. It's kind of like alcohol. You don't have like illicit alcohol, makers out there. It's highly taxed, but you still don't have a bunch of, maybe there's some, but, effectively, it's all come into the legal scenario. And so basically what you're talking about over time is the marginal producers, the low cost producers of cannabis are like destined to go away, which means like hundreds of percent growth for, if you just have the same size pie, it's hundreds of percent growth for, the legal players. And then of course, the potential for that market kind of expanding. And I think like young people, for instance, are much more likely to, consume cannabis than they are. I don't know if they're more likely to consume cannabis than they are alcohol, but there's definitely a shift. The younger you get, the more biased you are in favor of cannabis over alcohol. It's definitely not as harmful. So I think there are a lot of like, great tailwinds for the sector. It's not that easy to invest in. But it's a long-term theme that I have, a lot of confidence in. I don't think I have as much confidence in that as I do like in, Bitcoin long-term or, this migration trade that I think is going to continue, particularly into Texas.
I think it's a good place to wrap up.
Awesome.
Thanks for joining me today, Mark.
Thank you. I hope I didn't babble along too much.
You're the best.
Yeah, appreciate it.
Jason, as we sat back years ago and were envisioning where Fort was going to go, we realized we needed to bring in a global workforce, a remote workforce that could work with us. And a few of the reasons why were obviously cost, which I think is the first thing that comes to everybody's mind. But then when we talk about shifts, a 24-hour shift, and maybe you can go a little further there, and some of the other benefits that we've realized as we've gone on. And now we sit here today in 2022. At the time we first had this was maybe 10 employees. Now we're at 46. Mm-hmm. And as you think about the next chapter and how we're scaling, it's almost inconceivable that we would do it without Relay Human Cloud. So can you just talk a little bit more to how the shifts work at Fort and the productivity and some of the other benefits that we've learned about working with a global workforce?
It's actually been pretty transformational from how we think about how we're going to not only get stuff done today, but how we're going to get stuff done in the future as we grow. And so when you start going down that path of thinking about you're going to start working with people on the other side of the world, right? There's a lot of questions that come up. How are we going to do it? How are we going to train them? How are we going to manage them? Who's managing them? All those things come up. What we found with Relay Human Cloud was that all those thoughts had already been taken care of, and that we could focus on what type of talent is there that can join our team. Does it fit our need? And once we saw that all that thought and energy had already been put into the operational part of managing and running a team and the thing that we focus on here locally, then it was just a matter of finding the talent. And what I think that Relay Human Cloud has done really well is find a lot of great talent. And, these are people that are highly educated, that can provide a ton of value to a company like ours that otherwise we can't find here. And obviously, it's at a high or a extreme cost savings compared to what we could find here. So what we started looking for was how could we supplement what we currently do with the team overseas. And it started off for us from an accounting perspective. We have a lot of these things that are repetitive, task driven, that just never end. And we knew that our team was taking on a lot of work during the day, which was limiting our ability to take on new properties. And so we have a choice. We can hire another accountant or another staff accountant, or promote somebody and bring that person on. But we're really just trying to solve, at first, a repetitive task. So when we reached out to Relay Human Cloud, we discovered that not only could we solve that problem, we could get a very qualified person that could not only do that, help support on a lot of other things. And so very quickly it turned into, we're trying to solve some repetitive tasks, to bringing on more and more team members that were actually helping us grow our accounting department without having to bring on a lot of people here. And so that just continued to grow. So since then, we've brought on additional assistants, but it started with accounting. The benefit of having a team working globally is that you get the benefit of around the clock, and it never ends. And so because we have a team here working on things, obviously the time runs out during the day, but there's things that they're gonna come into work tomorrow, and they're gonna have to start doing that again. One of those things is, and a good example is, cash reconciliations of every bank account. At Fort Capital, we have 50 bank accounts, and there's cash reconciliations that have to happen every day. Well, that was something that locally a team had to come into work and start working on every day. Well, that just means there's other things they can't start working on. What happened immediately with our team at Relay Human Cloud was that overnight they were processing all those. They were doing all that accounting work on the back end, so that when our team showed up in the morning, they could start on more important tasks that were happening locally, directly related to the property. And that allowed us to create efficiencies. And so that's just one benefit. We can go through an entire list of things that we have discovered that overnight can be done to help increase the efficiency of the accounting team. That extends beyond the accounting team. It also extends to the property management team, processing invoices. So Fort Capital, we have millions of square feet of industrial space across the country. And with that, you have a lot of invoicing that's happening at all times. You could name a million things, whether it's paying bills, contractors, tenants, whatever it is. There's a million invoices and that can all be processed in India overnight, so that when our team comes in, they're not spending their day processing invoices, which allows us to get to more proactive accounting measures, so that we're using our accounting team to actually push the company forward, not keep up with what's coming at us, right? And so we found a ton of efficiencies by having the 24-hour workday.
So following that up, it was also important to us, because that could have been done anywhere, but we wanted it happening under one roof with people that we knew, that we worked with daily, that were part of our team. And so as you think about these people that are halfway across the globe, it still doesn't seem like it seems like they're in the next room over.
Right. And that's a good point. And I think what's important to understand there is that this group of individuals that are working in India are working directly for our team. They are a part of our team. They're in our systems. They communicate with our team every day. They are not just an extension of our team, they are a part of our team. And so it is much, much different than if you go hire a third-party service out there in the world that you're asking to process invoices, who you're having to send critical or important data to that is, or might be sensitive, right? Information. We actually have all that internal, and this team is a part of that internal team. And so it's a much different way to look at outsourcing than if you're just outsourcing it, even here locally in America. There's a risk there that you're sending your data to somewhere else. This is all happening internally.